Hello and welcome to the Fed meeting, video I guess. Look, so the Fed meeting, they did raise interest rates by 25 basis points. So if you don't know what that is, it was 0 to 0.25%, now it's 0.25 to 0.5%. Which was expected, let's face it, as investors we did know this was coming. Big headlines of the meeting, boom, inflation to continue mid to late 2022. 6 more rate hikes expected, and projected interest rate to be 1.9% at the end of 2022. So that's what the Fed predicts. Now, of course, we're going to untackle this all in a moment. I say a moment, we're going to do it now. So, first of all, an interesting thing I actually heard Jerome Powell say. The ratio of 1.7 to 1 of job openings to people. So basically, what this means is for every person that's actually looking for a job, there's 1.7 job openings for them. So there's more job openings than there are people looking for jobs. So of course we've got a very strong labour market there. That shows very strong labour market. You know, often we see businesses that can't even fill their job roles because there's not enough people to go around. So that's looking very good actually. That's very positive. Balance sheet to shrink from May. Balance sheet. So yeah, so the Fed will actually start to sell their bonds from May. So obviously we saw them tapering, so they started buying less and less and less. And now they're starting to reverse that and they're starting to sell these bonds from May. So it's just more hawkishness from the Fed, and it just adds to this risk-off sentiment that we currently have in the markets today. So what else have we seen? Well, interestingly, the Fed said economy is strong to deal with policy tightening. So basically, the Fed said, look, we weren't going to tighten the policy, we weren't going to raise interest rates, we weren't going to start selling our bonds, we weren't going to shrink our balance sheets until we saw a strong enough labour market. So they weren't actually going to do any of this. That's why we're seeing interest rates so late, because they believe that if we raised interest rates earlier, then that would affect the labour market a few rate hikes down the road. So that's why they've left it till now. We see inflation really high, so now they're prioritising price stability rather than jobs and the economic growth, let's say. So of course, as we see, 6 more rate hikes expected, probably 25 base points, and 1.9% in total. Well, we're going on to that in a minute. So let's have a look. Projected interest rate to be 1.9% end of 22. We've discussed this. I actually thought this would be higher by the end of 22. I thought the Fed might be a bit more hawkish on this number. But of course, this is all to be, to be determined in the future, isn't it? If we see more political issues in the world, Russia-Ukraine tensions heighten, higher inflation, you know, inflation might not come down, then we might see this figure change. So that's a bit of a changeable figure there. Anyway. Restore price stability while sustaining strong labour market. That is the main aim I could get from the Fed this meeting. You know, they want to restore price stability, they want to bring inflation down. That's what one of their priorities is. However, they want to sustain a strong labour market whilst doing it. They weren't going to raise interest rates until they thought that the labour market could deal with these rate hikes, could deal with a shrink of a balance sheet, could deal with less money in the economy. They weren't going to raise interest rates till that. So they actually predict that unemployment rates won't go up this whole rate hike. So they don't think recession will happen, and they don't think unemployment rates will go up, which is interesting because those two things go against each other, don't they? We often see that if we want inflation to come down, we have to tighten the economy, we have to take some money out of the economy, take some steam off it, and we have to see unemployment rates rise. You know, we see some people not be able to find work or be out of work. So yeah, but no, the Fed thinks unemployment rates can remain the same. They think they've got a strong enough market to see it through. Because, of course, as we said, the ratio of 1.7 to 1 for job openings to people. So that's an interesting concept, because that means that the Fed can tighten, they can shrink the balance sheets, they can tighten, they can raise the interest rates, all this, that, the other. And that could still go down to 1 to 1. And we would still see the same labour market as we would today, wouldn't we? Because 1.7 to 1, well, there's just not enough people to fill the jobs. If we go 1 to 1, then there's still the same amount of people to fill the same amount of jobs. We wouldn't actually see a massive change, but yet we have raised interest rates quite a bit. So that's where they think they're coming from. Yeah, we've mentioned that, isn't it? Raise interest rates when labour market is strong enough. We've mentioned this, so we can sort of skip this one. Well, as investors, so we've got here, look, 6 more rate hikes. We've got ratios. We've got a really strong labour market. We've got balance sheet to shrink from May. They also predicted GDP outlook to be negative, and they've raised more inflation. So as we remember, look, inflation to continue mid to late 2022. So they see inflation still continuing, which is kind of weird because the Fed just seems to keep pushing it back, don't they? One minute it was September, And then it was, oh, inflation's persistent, not transitory now, so we see it as March, April time. Then it was the war, so now we're seeing it mid to late 2022. You know, when is inflation going to start to actually come down? You know, this figure could change in the coming meetings. So yeah, it's all subject to availability. But I sound like a credit application there, subject to availability. But yeah, that's all. As I said, predetermined. You know, it's a bit of a risky figure to say now. But anyway, let's just go on to the next thing. As investors, yeah, that's what we're here for. As investors, we're all investors. What can we do? You know, we want to make money in this market. You know, and the markets, you know, it's very risk-off sentiment. So what can we do? Well, gold outperforms stocks during rate hike cycles. So that's something that we can look at, isn't it? You know, I've been saying on the channel for a while, if you're not, please do subscribe, you know, please do subscribe. Welcome aboard, eh? I did go through these videos, well, weekly, Monday, Wednesday, Friday. Monday is my saving up for recession, because I'm a little bit hawkish on this situation. You know, I don't think the Fed really knows what's going on with inflation. So yeah, but anyway, I go through it all, so yeah, please subscribe for that. But gold outperforms stocks during rate hike cycles. So yes, I've been saying on the channel, and I am an investor. You know, I talk where my mouth is. I don't say I'm going to invest in something and don't. I have bought gold, and I am an investor in gold, and I believe in gold long term. When I say long term, I mean sort of short term, like next 6 months to a year/2. Depends on what goes on politically in the world and what the Fed's saying. But for now, gold I think will do very well. So I've bought into gold. As I said, I think it's a risk of sentiment. Just watch out the Russia-Ukraine situation. I'm keeping a big eye on that because, of course, we don't want this Russia-Ukraine situation to escalate. So we would all welcome a peace, wouldn't we? We would all love Russia and Ukraine to sort things out and Russia to pull out. So if we see that happen, then obviously I'll gladly switch off to a risk-on sentiment, and then we've got stocks flying, and yeah, things are looking really high and looking well. So yeah, I'm keeping an eye on the Russia-Ukraine situation. Hopefully things will ease off. If it doesn't, then I'm protected by gold. If it does, then we can sort of tweak our portfolio into stocks. So we're hoping for that situation because, quite frankly, stocks and a risk-on sentiment perform better than gold. So yeah, we're and from a humanitarian point of view, we are hoping Russia do pull out of Ukraine. Saves lives, well, everywhere, doesn't it? Protects Europe, protects NATO, protects Ukraine, you know. So, all in all, that's the best case scenario. Financially wise and humanitarian wise, so that's the good thing about it. So yeah. As I said, key takeaways from this. Projected interest rate to be 1.9% at the end of 22, that's what the Fed was saying. The Fed was saying slower economic growth, higher rate of inflation projected at the end of the year. Which is, well, not what we want to hear really, is it? Inflation to continue mid to late 2022. Unfortunately, they didn't actually put a month on it. I was expecting a month. I was like, Jerome Powell say a month. But they know if they do say a month, then, well, the markets could react like, couldn't they? And when the month comes and inflation hasn't or has, then the markets could go in a bit of turmoil. So he knows what he's doing, and he didn't want to put a month on it, which is fair play to him. 6 more rate hikes expected, so we can look out for them if that does happen. And yeah, balance sheets shrink from May, so they're selling off bonds that we see. So yeah, that's all looking quite interesting. As I said, I'm currently risk off sentiment. And yeah, I'll see you in the next one, people. Just be careful in these markets. It's risky out there. I don't want you losing money. See you later.